With interest rates remaining at record lows, securing a sustainable income stream has become an elusive goal for countless investors approaching retirement. In part 2 of Legg Mason's Advisor Education series, we speak with Rhys Birtles, Chief Investment Officer at Martin Currie Australia, to examine the prevailing economic challenges facing retiring investors and how an equities-oriented investment strategy can offer the ideal vehicle for delivering sustainable income.
Retirees face the challenge that interest rates are at record lows, so the amount of income produced off traditional assets such as term deposits is insufficient to fund their retirement. They also face rising cost of living as well as volatility from traditional investments in terms of their portfolio. One of the interesting facts about Australian equities is that the income produced from the dividends of the Australian market is actually far more stable than the income produced from term deposits. So over the last 5 years, whilst term deposit income has fallen over 60%, the dividend income from the Australian market has continued to grow. And Australian retirees are lucky in that Australia is one of the high dividend markets in the world, with very strong dividend income, as well as the benefits from franking credits, especially for retirees. It's the right time for income investing because the Australian population is ageing, and that we've moved from a situation where most people were investing their superannuation in the accumulation stage of investing. When they get to retirement, the problem they face as investors is about a sufficient income to support them for the rest of their life. And in this context, Australian equities are a very attractive asset class with a much higher dividend yield than other global equity investments and term deposit investments, plus the benefits from franking credits. And the income from Australian shares grows with the Australian economy, so faster than the inflation rate, and that helps a retiree offset the rising cost of living. Legg Mason's approach to producing a portfolio that is suitable for providing a sustainable income for life is to think about a high income stream, including the benefits of franking credits that retirees or 0% taxpayers have, as well as reducing the risk of that income stream. So rather than the Australian market that is, for example, highly concentrated in banks or in individual stocks like resources, we look to diversify the sources of income with a maximum exposure of 5% to any single stock, so that when we build a portfolio of high quality companies that can continue to pay and grow dividends over time, there is less risk that that dollar income stream won't be delivered for the retiree. The traditional approach to thinking about risk is to think about share price volatility alone and thinking about correlations between asset classes. So for example, in the accumulation stage, global equities tend to be diversifying as it introduces currency risk and alternative sources of growth. But for a retiree, global equities have a very low dividend yield, which is insufficient to cover the cost of living or the drawdown rate that a retiree may have. And in addition, they pay dividend withholding tax rather than Australian equities having the benefit of franking credits. The key differentiator of our strategy versus other equity income products is it's truly been designed for retiree income needs. It's not designed to maximise the yield or just maximise the franking credit, because those strategies tend to be returning capital to investors. And if they're returning capital via derivatives or excess payout ratios, then it means that the value of their equity investment won't support them for the rest of their life. Whereas our strategy has been designed to deliver the genuine dividend income to retirees, maximise the benefit of franking, and think about risk in terms of delivery of income risk rather than benchmark aware risk or tracking error, where our focus is purely on delivering a dollar income stream and having that dollar income stream grow each year for the retiree.
Thank you for watching part 2 of Legg Mason's Advisor Education series. Tune into part 3 where we'll explore the unique benefits of an unconstrained, benchmark agnostic investment approach.